Be careful what you wish for. Jobless claims topped higher today. We have ADP that came out that said private payrolls are decreasing. We have job openings that have dipped below 10 million for the first time in 2 years. And yet you have job losses that are taking place are up fivefold this year compared to last year. All signals should tell us that the Fed is going to stop hiking interest rates, which should be a good sign for the bulls and for stocks. However, now we're talking about recession, and now we have that to worry about. Welcome, everyone, ladies and gentlemen, to Buy, Hold, Sell. I am your trader, Todd Schoenberger, and I'm joined by my friend and co-host, Tobin Smith, out in sunny and hot Scottsdale, Arizona. Toby, I know that you are not feeling well right now, so we really appreciate you coming on. I know the audience is just on the edge of their seats, just waiting. They're just glad you are a long distance away, though. That's for sure.
Don't make me laugh. It hurts. It hurts, okay?
And we do have a very special guest with us, though. It is Steve Strazza. He is the Director of Research at allstarcharts.com. And Steve, I want to go to you first because you have a lot to say, but here we had the big jobs number that's going to be coming out tomorrow. But with all the headwinds, I mean, forget about the jobs report. You got earnings next week. You have so many other factors that are taking place. What are you telling investors these days?
You know, it's weird. It's really a tale of two markets right now, right? A chart that I've been bringing along and sharing a lot with clients is it's showing tech moving in one direction and then banks moving in an opposite direction over the past month now, right? I don't think that's sustainable. I think you always need the banks to at least participate in a real bull market. But then meanwhile, for the bulls, we can give you a long list of bullish developments that keep coming, right? And we continue to see risk on developments. Sure, there's been a little bit of a defensive trade over the trailing few weeks, but you know, big cap tech is ripping, and growth stocks in general are ripping. And I think it's really an interest rate story. We have to be very cautious of the banks right now. I'm watching the regional banks because they're the market laggards right now, and there's always information in the laggards in the sense that they should lead to the downside. Right? If we're going to make a fresh leg lower and the S&P is headed back to the lower bounds of its range, then I think that you're going to see the regional banks lead that, right? So you're going to see these bear flags break lower. That's probably going to mean XLF and financials below those prior cycle highs. And I think things get dicey if that's the outcome.
Okay. All right. Well, Toby, what do you think?
Steve, I'm with you. Here's what I didn't quite understand. So I'm the macro guy, right? And, you know, you can't get inflation down to 2% unless you have exactly what we're having right now: slowing, job cuts, less, all that stuff, right? So, excuse me. In the past, when we got bad news, it was bad news was good news, right? Because bad news meant that the Fed, was. So then I'm looking at this, today from yesterday.
It's blurry. It's blurry.
Oh, is it blurry? Okay.
There you go.
Yeah. The shares decline on signs of slowdown. Really?
Yeah. Now we have to worry about the recession.
Yeah. What was different about yesterday than the slowdown we've been having for the last 60, 90 days? That's sort of the fickle figure of fate award when it comes to the street, because, it's like, I didn't really care about it 2 days ago, but all of a sudden, oh my God, we're actually slowing. Well, geez, that means we probably have a recession. And oh, by the way, and to JC's credit, your guys' credit, you had said back in June of last year that basically, we hit sort of this bottom and we retested it a couple of times. But now, if slowing growth does mean lower earnings per share, which does mean overall, lower stock, then we shook it off in a day. That's what I think is just so bizarre for people. And you're a price action guy. I'd love to know, between the 3,800 and the 4,100, what do you think does it take for us to break out of that channel?
Really, you want to see an expansion in market internals. But I would like to just speak to your point about bad news being good news in the past and maybe that's changing. I think you really want to watch the bond market for that, because you're right. Bad news was good news for so long. We kind of got used to that. We've all been dying for the Fed to pause. Now that the market's pricing in a Fed pause, what if they start pricing in a recession, right? And bad news actually becomes bad news. You want to watch the bond market. I think rates, this year will be like the dollar last year, where I feel like we were constantly pointing to the dollar in 2022 and saying, what are the intermarket implications if the dollar peaks here? And we saw stocks bottom, right around last fall when the dollar peaked. I think this year, the big intermarket story will be rates, right? Are they just in a sideways range here? Or do they take out these 2018 highs, which for the 10 is like 325, and plunge lower? If you start to see rates really start moving lower with momentum, that's never a good thing. That's the market pricing in more bad news, recessionary stuff. And that bond market volatility will flow through. It always flows through, and it will impact risk assets. You'll see some.
That's a great point. I started off as a bond salesman, when your parents were born, and I used to sell I would, when in 1982, when the 10-year bond was 14.5%, 14.78% to be exact. I would go to these pension plans and I would say, do you understand that you're buying for the existing bonds, you're buying these things at about a 65% discount rate to their actual face value. And when the rates go back, you're going to make more money on the appreciation of your bond than on this freaking 13, 14% yield. And they would say, Toby, you're so crazy. Everything's going to 20%. In other words, people got so soured. And one of those funds was down your way, like the Key West firefighters, pension plan or something. And I looked them up like 10 years later, and that the 8 million they put into bonds that time was worth about $98 million. It just goes to show, when people are confused, to your point, the bond market is the only binary yes/no thing we can look at. And so I'm with you on that. For people at home to understand that if who's a money manager, and if I'm buying, 10-year treasury bonds, I'm buying them defensively. I think the world's going south, and I know that their value are going to go up because the yields are going to come down, because that's a safe place to hide. Yeah. But I also think the same dynamic, Steve, is about the mega tech stocks. If you don't need to borrow money, matter of fact, you have $1 trillion or more in cash in 10 years and 20 years and in money markets, that's a safe place. They don't need to borrow money. Their business models are recurring. But this time you're buying them for a reason. It's not just FOMO, YOMO, HOLO. There's a real reason for safety in a slowing economy to buy technology companies that have monthly recurring revenues. It makes sense.
I think so. If it's a slowing economy and that's why rates are falling, I think they'll be falling faster. They'll be falling with that, alarming rate of change to the downside, which will cause volatility, right? If they're just dripping lower, or if they're in some sort of sideways range but trending lower, there are some risk assets that can do really well in that environment, right? If we're talking about rates just peaking, or at least the Fed's hiking cycle being over for now, right? Yeah. You got Bitcoin, big cap tech, bonds will do well, bullion, the 4 Bs, right?
Yeah, gold.
They're all long duration assets in a way. Maybe gold is a little bit different, right? But the other three, they're long duration assets. And when rates come down, the way that we value these things, right? The discount rate on that comes down, and the future cash flows are worth more, right? It's really as simple as that. It's just math. So I think what we're seeing from big cap tech.
Yes, Steve, you're right, but there is no cash flow on Bitcoin. There is no cash flow on gold.
No, but aren't they really the longest duration, long duration assets, even though they don't have cash flows yet? We treat them like tech stocks.
Listen, I'm the original Bitcoin bear, because it's only cost me about $25 million when I could have bought the freaking stuff for nothing. Not that I'm bitter.
That's another story, Steve. That's a whole other story.
Not that 3 guys from my high school came to me and asked me to borrow some money to buy Bitcoin in 2013. I said, listen, I love you guys. I don't want to, be enemies. Now they live in Santa Monica with $100 million of Bitcoin apiece. And they send me notes every once in a while, sucker. But yeah, Bitcoin to me is an alternative issue. Bitcoin, in my perspective, is that you have to have a certain rationality. You have to have a certain political libertarianism type, feeling that says that when all that fiat money goes down, this thing really has value because there's a fixed amount of number. I understand that.
Yeah.
JC turned me on to the gold trade back in June. I mean, we always, when the dollar's going down, we always buy silver and gold. And, I actually buy those Credit Suisse income funds, the SLVO and the USOI.
Yep.
And also, let me just preface this for the audience. I'll set it up. JC Peretz he's from All Star Charts. He did a show with us on Buy, Hold, Sell a few months ago that was extremely successful.
Yeah.
So we welcome the audience to go back to that and listen or view it. And I think you'll get a lot out of it. But real quick, guys, I do have a question because there seems to be, are we a bit premature in thinking that rates are going to be going down? I mean, you have the jobs report coming out. It's the last jobs report before the May 3rd meeting. You have a CPI number that's coming out. I know the Fed, that's not their big gauge for inflation. But regardless, I'm not seeing, the fight for inflation is still going on. So you have to suspect that the Fed is going to hike again. It could even be later on. I mean, I don't think we're out of the woods at all. But Wall Street they want something to happen that just isn't happening that fast.
Well, I'll start this, Todd, just this way. Steve does price action. Price action is the truth. At the end of the day, it's what actually people are doing.
That's right.
At a different level, though, the narrative, when we went through this, I don't know if you know this, but the last couple of weeks, we had some problems with the banks. It seems like we've already forgotten that. But when the entire U.S. banking system is now tightening their credit standards and their duration and selling off those bonds and doing what they should have been doing, which is to at least hedge their exposure to these long duration assets, blah, blah, blah. That is tightening. And I think a lot of people that I follow and respect have come up with the number individually that's like 0.5% or a 50 basis point rate hike simply because of this tightening in the banking system and in the monetary system.
Probably more.
Probably more. Steve, I agree. So that's the new narrative that I think holds a lot of water, that the Fed really, maybe they're going to raise 25 basis points again, because I've argued that you can't, if you saved the banks, then you can raise, 25 basis points and you're not putting people at risk. And so that mixed message would get lost. But the actuality is this tighter 50 basis point monetary system from the rest of the regional banking. Look at the biggest risk in the banking system are their commercial real estate loans. And nobody knows where that is. But if you look at the small banks and even the regional banks, they're 90% of that lending. And I don't know about y'all, but we have 3 buildings down the street about 2 miles away in beautiful North Scottsdale office building area that have been foreclosed in the last 2 weeks.
And they don't even know how to value these things, Toby.
Right.
What are these things worth on their balance sheet? Because they have no comps, right? So that's a huge issue too. You can't really trust their books right now.
Yeah. So I mean, the next shoe to fall in the banking system is going to be as soon as they start reporting these repossessions. I mean, Pacific Life had one of their buildings, taken. San Francisco, of course, is in sad shape because everybody's moving to Key West. I don't understand it. So we're not out of the woods here, and these assets, that's the next shoe to fall in the banking system. But to my original point, then that tightens the monetary system even more, which now we're finally seeing the slope that I've been looking for, just doing the math on growth, on job growth. We're actually below 10 million, as you said, Todd. We're gonna meet somewhere in the middle. It's not gonna be a 50-50 thing where we lose jobs, gain jobs, and we sort of score off at 5 million. But there's the narrative shifts. It seemed like every 10 to 15 days, and right now, if we are slowing and that the Fed is done, then I'm sorry, but I go back to the same malarkey we had 4 months ago, which was, the Fed's gonna pivot. They're gonna start cutting by 50 basis points. Not going to happen, because if they do that, that tells the bond market, to Steve's point, that something is really effed up here. And I'm running to those 30-year, 10-year bonds for pure safety. I don't care what I pay for them. And that's bad news for stocks.
So are you suggesting that maybe they do this last 25 basis points just because they don't want to spook the market by not doing it?
Yeah, that's my call. I think a lot of other people have the same call. Simply because excuse me.
Oh my goodness.
Yeah, that was hurtful.
What is 25 basis points going to do now? That
Nothing.
from the banks,
Nothing. It's just
lending standpoint.
it's just telling the story that
It's symbolic.
we have this under control. We understand what's going on. Don't worry about it. But we don't want to start the narrative that we're cutting here because, we actually see everything in real time, 24/7, 365. We got 115 freaking PhD economists that see every bank, every member of the Federal Reserve. They see exactly what they own.
Yeah.
Somehow they missed Silicon Valley Bank, so that sort of dented their credibility a bit. So they don't want to be in that position because it's all confidence, Steve. I mean, at the end of the day, giving your money to a bank is a confidence you're going to get it back plus interest.
Yeah.
Buying this, shares in stocks is that you have confidence in what. And that's the only business they're in. They're in the confidence business. When confidence gets broke, look at 2007, 2008. We made great strides in every bank that's above the $250 billion mark. I'll still never understand why. Yeah, but we can still let the shitty guys, borrow as much money as they want and have no assets. But we need the big guys to be solvent. Well, now we got to look at the people under 250 billion and solve that problem.
That's right. I tell you what, let's close it out on that note there, because I do want to get both of your thoughts coming up after the break about that, because Jamie Dimon came out and said the problems with the banking sector, we should not be forgetting them, because that's likely going to be the catalyst that's going to lead this country into a recession. And I'll be interested.
Todd, if I don't make it for the next section, it's because I've died of snot.
There you go. Well, I do want to know, if that's the case, what's that mean for stocks and what investors need to hear?
What does that mean for stocks? I don't care.
Exactly. It'll be horrible. It'll be the end of this show, that's for sure. So okay. Well, we'll talk about that after the break. So we have Steve Strazza. He's Director of Research from AllStarCharts.com with us, and he's going to stick with us right after the break. So please stay with us.
Hi everyone, I'm Veronica Dudo, and welcome to Buy,
Hold, Sell. If you have the Russians that are going into Ukraine, the Americans and the Germans and everyone else in Europe is going to say, hell no.
If Russia doing things, logically was their MO, I'd agree with you. Yeah, Todd, why don't you get him on a phone call right now? Hello, you.
Welcome back to Buy, Hold, Sell. Well, the S&P 500 did close a little higher today. However, for the week, and this abbreviated week because of the holiday, it's our first losing week in the last 4. But what's that mean for next week? Because we have so much going on. You got earnings coming out. You have a CPI report coming out. And all of this is on the tail of the jobs report, which comes out tomorrow, even though the markets will be closed. So we do have Steve Strazza. He is Director of Research. He is with AllStarCharts.com. He's with us today on Buy, Hold, Sell. And Steve, one thing that we just learned about you during the break is that you actually have an accounting background. You would be known to go into some of these banks. You know how to audit the banks. So now with all the troubles that we heard from the banking sector over the last few weeks, and then Jamie Dimon at JP Morgan said that's probably going to be the catalyst that's going to really get this economy down into a recession. What do you think, though? What's that mean for investors? I mean, should we be looking for safety, or should we maybe consider taking a little bit more risk?
If Jamie Dimon is right, and I think there's a fair chance that he might be, it's going to be a problem, right? Like, one thing we say as technicians, one thing that I've learned over the years, you don't have real bull markets without the banks, without all the financials. You can't have the financials falling like they have been and the rest of the market doing fine. Yeah. Sure, you'll have divergences and moments where that'll dislocate for months at a time. Even we're seeing it right now. It's not sustainable. So I think we need to watch the price action there. And what it's telling us right now, if I look at a chart of the regionals, they were making new lows just yesterday.
Yeah.
Right? So what happened was in March, we flushed lower. These were nasty distributive patterns already, but we got a huge, heavy move to the downside on the Silicon Valley Bank blow up. Then ever since they've just been coiling. So they're in bearish continuation patterns. And if there's one thing that we know about these bearish continuation patterns is that they tend to continue in the direction of the underlying trend. If the banks start resolving lower from these little multi-week continuation patterns. That's the banks telling us through the price action, through the message of the market, that there are probably more bank failures to come. I think Jamie Dimon will be spot on if that's the price action that plays out in the coming.
Well, Steve, that
more
is
bank failures, more bank failures. That's a
Yeah.
hot take right there.
right.
And here's the thing, there's a fundamental reason too, right? All of these regional banks, they're in the business of lending. So, everybody wants to come out, and it's such a hot take right now to say this is not systemic. Here's what is systemic, and I know is systemic. Interest rates rose at the fastest pace of all time in history, right? And all of these banks have to manage that risk, right? So if you didn't do a great job balance sheet management and you have a ton of unrealized losses in your securities portfolios, that's a systemic risk that all of these banks are dealing with to some extent, right?
Yeah.
And if investors keep taking their money out, then that's eventually you're gonna see, more banks actually blow up in the same exact way as Silicon Valley.
Yeah, Steve, I couldn't agree more. I mean, here's the, on one hand, or other hand, macroeconomist. On this hand, we have 3.5 going to about 5 trillion in money market accounts that are connected with brokerage accounts. So that's more dry fuel than we've ever had, on a percentage basis of the market cap of the market and money market accounts. On the other hand, by moving your money from your 0.35 of 1% interest rate on your CD to today 4.5, 4.75 in a money market fund, makes that deposit go away, which then the banks need to raise their rates to keep just their deposits, and because they're operating on these highly leveraged, portfolios. That's the definition of a bank problem, of a systemic banking problem, because I'm watching the CD rates as close as I'm watching the bonds, because your point is extremely well taken. If the banks are hurting, then their yield, their threshold for risk goes down, and their threshold for problems goes up. That's not healthy for an economy.
I think like an important point about all this is Silicon Valley Bank didn't blow up because they were messing around with credit default swaps or some sort of weird mortgage-backed securities or doing funky stuff. It wasn't fraud. It was nothing. This is banking 101. This is what banks are in the business of doing. Right. They have to make more money on their investments than they're paying on their deposits. When rates move up very quickly, the way they did the past several years, that game becomes a lot harder, right? So I don't think they're the only ones who are vulnerable right now. And for everybody to go around saying this is not systemic, maybe systemic's just a bad word that we should throw out and never use again because of the financial crisis. It's a broad issue, right? It's something that all these lending businesses are going to deal with. And even the money center banks, which should be fine, and all I'm hearing is about how they're going to benefit from this and get more deposits because of it, which is probably true. The market's not pricing in great stuff for them either, because Bank of America doesn't look so good. JP Morgan doesn't look so good. Maybe the market's pricing in there the fact that they're going to be the ones paying for all this. If you're going to insure all of these deposits, the banks are going to be the ones pooling money into that insurance fund. So maybe that's the market kind of discounting that aspect of it. But none of the banks look good, and that's never a good thing for the broader market.
Well, Steve, great to have you on the show, and the fact you agree with me is fantastic, because that makes
I agree too much with you. I usually like to argue a little bit more, get some good. I agree with you too much.
But I will, Todd, I do think, for listeners out there who, are nervous, and people are nervous, I just always say that, look, when I'm getting paid 5% almost in my Interactive Brokers, money market account for doing nothing, and I'm sleeping better at night because I'm not worried, then that's the approach you need to take. There's nothing wrong with not calling the bottom of a stock market cycle. There is something wrong if you miss the top, but that's water under the bridge. Use every hackneyed metaphor there is. But if you have enough cash so you're not worried, then that allows you to be brave when it's valuable to be brave. I'll use this example. So we just put a big research report out on the artificial intelligence world, and my research group of about 1,500 people around the world, I didn't realize that about 50 to 70 are actively in the AI space, et cetera. And it's been just wonderful over the last couple of weeks to put this stuff together. The AI revolution is off and running. And regardless of whether C3.ai, which got a report out that they had bad banking or bad disclosure stuff, which again, it's a bizarre to me in this world where I, as a short seller, can put out a report against C3AI, be actively short that stock, and make money based on my opinion. That's a topic for another day. But the AI business has launched into a global phenomenon. Every 15 years or so, we get the tech stack transformation. We went from MS-DOS, and then we went to Windows, and we went to iOS, and we're now going to be in this next great thing. That opportunity is not going away. It has nothing to do with the banks. It has to do with a variety of other driving factors. So you don't want, in my messages, you don't want to get too down on the market. But to Steve's point, you better be aware. And the telltale sign is the banks, are the financials, because they're the ones that, remember, Silicon Valley's bank's issue was that I believe, like a lot of people, and this is no shot at you, Steve, but if the person wasn't working during 2006, 2008, 2009, and gone through that, or even, like for me, gone through the, early 1980s, when both were raised rates to 17, 18%, I think it's beyond a person's imagination of what can happen when, bank rates go up this fast. And essentially, the Fed made those 30-year bonds and 10-year bonds that Silicon Valley had no business owning without a wrap, some type of
right.
It made them into toxic assets. And the only way that they escaped this was that they were under $250 billion market cap. They didn't have to mark-to-market report that. Well, the other risk I would say, Steve, that's coming is this always happens when we get a big FUBAR, is there's going to be a lot more regulation on the banks under 250 billion, and to market your losses means that the other side that people have never imagined. People don't know that between 1986 and 1994, we had 1,500 savings and loan banks close. No one ever mentions that.
Right.
And it's almost the exact same situation where we were raising rates and they had locked and they had to mark to market and they closed. They went bankrupt. Well, we're not going to have that. But
let's hope not.
Yeah, but underneath the surface, if you're totally mismatched, what people, the regulators too, I'm sure they're all like 28 years old, didn't understand is that the deposits are not locked in.
Yeah.
People can say, please, I like this back.
Right.
They never imagined a bank run. They never imagined.
So Steve, going with that, because Toby's talking about, be aware, be cautious, buyer beware. You could be in cash if you want. You're collecting 5% on a money market, but if you are going to be invested, just be aware of the surroundings. Is basically what he's saying. But with that, we see. I mean, can you speak on gold? Because of all places, gold is almost to its all-time high right now, and still seems to be
and we're
rising.
buying gold miners for the first time in 35 years.
Listen.
Yeah. What do you think?
Gold looks great. You probably already know how I feel because JC was on here a few weeks ago. He's so bullish. He's like a gold bug again.
He's a gold bug. I told him I was going to send him a picture of his head in gold.
He doesn't he's a gold bug. 2000, right? 2100. We got to get above there to really complete this breakout. But if you zoom out on a chart of gold, I mean, it's beautiful. It's a nice handle. I mean, this base has been building for so long, absorbing all the overhead supply at this level. What we say is the more times the level has been tested, the more likely it is to break. We've been up at these former highs a couple times now, the 2011 highs too, right? If and when we finally go, you got to be long. The miners are going to be on fire. It's probably a good place to be.
Well, Steve, I'm also going to tell you that now that I'm becoming more Zoom worthy, we're going to set it up so you can show those charts when we're doing these interviews.
I would love to bring charts next time.
Yeah.
Let's do it.
Because it really tells the story. At some point in time, the words run out, and your eyeballs are your eyeballs. And when you see it,
we're in the business of data visualization. Well, we love the charts. I'll bring too many. You guys will hate me.
Yeah, and they're easy now, Todd. I'm such an idiot. I didn't realize how easy it is to share the screen.
Yes.
Oh, hit the button, share the screen. Okay.
Toby, only half the audience thinks that way about you, so you don't have to worry. Okay, so. But anyway, that's awesome. Go ahead, Steve. Final word with you.
So we're saying some scary stuff now, right, about the banks. So let me just bring it all back together. As a price action guy, like you guys have described me, we have a line in the sand. We always want a line in the sand. Like, where are we wrong, right? Because we're bullish, right? We're constructive. We think the overall market is still in a bottoming phase, right? You don't just go from a downtrend to an uptrend. There's a sideways trend, in between. That's what's going on right now. I think what throws a big wrench in that thesis is, like we said, if the banks and the financials keep collapsing. For us, it's XLF, which is the large cap financial sector spider, 3050. 3050 is that level. That's the pre-financial crisis highs. It also lines up pretty damn well with the 2018 highs, which is key level, and the pre-COVID highs, right? So if and when we break that level, you will see further downside, further selling pressure. The broader market will be under pressure, and it will warrant a far more cautious stance, right?
So 3050 on the XLF?
That's it. Most important chart, most important level in the market for me right now.
Okay. I like it. That's awesome. Well, that's great. Well, we're going to leave it there, and definitely 3050 on the XLF. We'll definitely get that out and promote that. So Steve Strazza, thank you so much for joining us. He is Director of Research at All Star Charts, and we do invite all of the audience to go to allstarcharts.com and sign up. They have a 30-day free trial. You have nothing to lose. Just give it a shot, and you'll definitely read a lot about what Steve has.
Steve probably has a suit and tie on at that site, though, too. He's not,
He looks sharp. Sharp man.
That's the case.
Great to have you on the show, Steve.
This was fun.
There you go. Definitely. We can't wait to have you back. So listen, to on behalf of Steve Strazza and Tobin Smith, I am Todd Schoenberger. Thank you again for joining us on Buy, Hold, Sell. We'll catch you next time. Take care.
Cheers.
I want you to smash that like button.